We are looking at structural risk management for a bank and the asset liability management. This is a document from deco.com. Quite an interesting one which I liked. You can download the whole from deco.com design spvf.en, and the name is Structural Risk Management Asset Liability Management.pdf. Now it delves more into what is the asset liability management and how to properly manage risk for changes in interest rate, and also when you have got foreign holdings and foreign currency. So this risk should be managed in a manner that contributes adequately to earning and limits risk to the financial margin and members' equity. Now, proper management of assets liability is facilitated through a board approved policy which sets limits on asset liability mix, as well as level of interest rate and foreign currency risk to which credit union is willing to expose itself. Now, when you look at it, there are policies that governs pricing, term, maturity of loan and deposit. The use of derivatives, if any, should be controlled by policy which should state that derivatives must be used to limit interest rate risk and must never be used for speculative or investment purpose. So this is one mandate that they are sticking. Credit unions which offer either fixed rate loan or deposit will mitigate risk by ensuring that management is properly measuring risk. The standard measure of the risk is balance sheet gap and is essentially the management and that is what the management would look at. Techniques for measuring, monitoring and reducing interest are given in this document that I am opening. The credit union generally meets and takes a look at the problem. Now this is something which is about the legislative summary. I'm covering this. The legislative relevant to ALM deals with management of interest rate risk. And if you look at it, interest rate is defined. There is some policy, regulatory shock test. Again, in the same dimension comes the stress testing for these banks, reporting requirement and corrective plan. Then balance sheet volume mix. There are various regulatory requirement and regulatory lending limits, investment portfolio, liquidity requirement. Now there is something in the FRM exam that we have which is called the liquidity risk, which talks and focuses about the liquidity. So their main idea here in the interest rate risk part is to understand the exposure to interest rate risk, techniques to measure interest rate risk, internal control, corrective action for high level of exposure, reporting required. Then there is a shock test in other terms or in other books. This is something like the stress test. Then you have the use of derivative, which can be done only for constructive purpose. The first topic in this document that we have on deco.com is balance sheet mix. ALM policy should establish portfolio limit on the mix of balance sheet liabilities such as deposit and other funding as a percent of total assets, considering the cost that you have. Now, if you look at the balance sheet and if you look at how a board policy limit size of a specified asset liability categories, you will see commercial loans 10%, personal loan 10%, resident mortgage. This is a big part of the bank. The liabilities are term deposit, demand deposit, foreign currency, brokerage deposit and liquidity borrowing. So this is how you'll look at. Now if you look closely at the assets and liabilities, the assets of the bank are loans that it has given. Point 1. Point 2, residential mortgage is a big part. And point 3, most of the money that the bank has is of term deposit. Now managing liabilities, which mean that managing this, the downside, in which the term deposit is the biggest part. So the section provide direction on setting policy constraint on the size and type of deposit. Alternative attract loan to meet deposit supply, attract funds to meet loan demand, adopt a mixed approach to match the maturity structure and the maturity structure of asset at the cheapest cost. The first approach is reflecting the deposit given growth generally results in a limited satisfaction. The second approach, which reflects asset given growth, results in higher than average funding. Now, term deposit. There is some policy of term deposit. If you remember in the FRM part 2 exam, you have that a part of term deposit. I think 100,000, I guess, is insured by the government, but not all. So offer 3 or 4 tier deposit rate structure, offer attractive first year on term deposit, and wait and see clause, and different kind of clause. Then you have diversification, brokered, and borrowing. Now you have managing assets. If you remember, assets is the loan. So productive loan, short term investment, non-earning assets are cash on premises, non-accrual loan, payroll receivable, and prepaid expense. The ALM specifies the pricing of loan and deposit should be offered so that the net contribution to earning is provided. Deposit pricing policy, loan pricing policy. The loan pricing would be on market rate offered by competitor, excess liquidity, credit risk of the loan, where you gauge what people are doing, and length of the amortized loan. Then you have terms, term deposit, term loan, operation procedure. Then you have foreign currency exchange rate. So this is a very light introduction about what's going on and how they are keeping the assets and liabilities. When we look at the financial margin, you have net interest and investment less loan cost upon average assets. So loan interest income, investment income, interest expense on deposit, other, which is the net interest and investment income divided by your average assets. Influence on financial margin is pricing policy, asset liability mix, timing of loan, investment yield, level of excess liquidity, interest rate fluctuation, foreign currency fluctuation. Now interest rate risk management, and this is an important point here. In terms of those job interviews and the FRM, this part becomes something that is important. So interest rate exposure can lead to operating losses, iteration of capital, and therefore must be periodically measured. Measuring interest rate in the most criterion, the interaction of portfolio rate maturity is so complex and left to intuitive to generate interest rate risk. Now, the portfolio volume rate and maturities yield curve is complex, so it cannot be left to intuitive judgment to quantify interest rate. Therefore, for accurately measuring interest rate required. The following are some techniques that can be used to measure interest rate risk. Gap scheduling analysis. We'll talk at the gap risk, but the gap is primarily in very simple word, it's between the loan and the deposit. Gap ratio analysis, 30-70 rule, earning shock test, dynamic gap analysis, simulation analysis, dollar duration analysis, and the other. So sample asset liability gap report. So gap schedule, gap ratio, assets minus liabilities plus equity. So this was a very basic introduction to the asset liability from the bank side. The financial derivatives that you are looking at here would be interest rate swap, floor columns, interest foreign agreement, foreign currency fluctuation, security options, stock index. An interesting thing to note here is that many prime brokers or banks that are ready to sell these instruments are available, and many hedge funds and other people are available who are selling these floor gaps column. So even if you are a big bank, you can get these derivatives from another bank. So that was all about the ALM part. I hope this was useful for you.